What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Happy Wednesday. Hope you guys are all doing well. Today, I am just going to go over the Bitcoin price. We got a little bit of a price jump here, a little breakout. I'm going to show you my chart and why I'm kind of excited about this particular zone on the chart. We're going to go over an old post that I had for Bitcoin Magazine Pro, and then look at a few just random happenings out there on Twitter and in macro. So let's share the screen and get right into it. So this is Bitcoin, and I'm excited about this level. So right now we're at 35,580, and this red line right here, which I will share with Telegram. Sorry, guys. This red line is the previous high close back on November 1st. And we went a little higher to set this upward or ascending channel, which is a bullish pattern for this flag here. Then also this dashed line right up here at 36,000, roughly 250. That is the resistance going all the way back to January of 2022. And it's not a daily close. It is a weekly close, a different price there for the weekly close. But that is the last line of defense. There's not really much else from a structural perspective above this that is going to cause us resistance. I mean, maybe you could say this formation from February of 2022, but if you bring up the volume by price, and you look at it, let me squeeze it down in here so it fits a little better. Okay, I'll snap that, show that to Telegram. So I'm excited about this level because structurally, there's nothing really above this. And as we get above this very near line of resistance, the volume by price starts to go down. So that means the previous resistance, previous volume at that price will act like a important level for people that bought at that price. So if you bought at 35,000 when it gets back to there is an important psychological level. And the fact that there's a lot of volume also draws other people's attentions and marks to that price level. So once we get past this 35,000, I think we're going to slide right up into this gap here. There's lots of different reasons for that, both from a technical and a fundamental perspective, but that's what I'm thinking. Okay, so that is Bitcoin. Right now we are breaking out of this. Let me take the volume off. Breaking out of this red line, going to the top of the channel, and the top of that channel is also breaking that resistance that dates all the way back to January of 2022. So this is a very important level. I think we can break it. There are some rumblings around the ETF starting to build up again. It's been a couple weeks since that has really been talked about very much. But let's go into a couple other charts before we get into the ETF news. Let's take a look at the dollar. And all of this stuff on the chart is, well, let me just hide all this stuff because we talked about this, I think on Monday, was it? With Telegram at the end there. But the dollar is stronger a little bit today, 105.57 right now. But nothing really spectacular to report. Actually, this pattern here at the end, I had to bring back all that crap. Let me just take this off. Sorry, let me clean up this chart. Hide this. Okay, so even this recent rally is below this previous formation of price. So I think that the dollar is going to struggle here. It's going to get a little bit weaker. And that I mean, it's not going to fall off a cliff or anything. The overall trajectory of the dollar is going to be sideways to up over the next few years. But you have to sucker people in. You know, we see this all the time on in macro, that the minute something starts moving in a certain direction, everyone builds out their narrative to say that their bias is correct. I wrote about this just today on the Bitcoin or the Bitcoin Magazine Pro. I said that the predetermined answer is inflation and the death of the dollar and the end of the U.S. empire. That's the predetermined destination. Now, everything else is then molded around a narrative to make that fit. Instead of how I approach things, I look at the charts. I look at the news. I say, look, okay, OPEC has cut 4 million barrels per day of production in the last year. And they say they're going to keep this production cut going until at least the end of the year. But oil prices are still dropping. Okay. So then you can look at those facts and be like, what is happening here? Something's really happening in the oil market. Something underneath in the global economy is making this move, not trying to fit my predetermined narrative. Okay. So that is the dollar. Let's go to the US 10-year. This is also having the yield is having a down day. That means that the bond prices are going higher. Right now, sitting at 452. And if you remember, back here in early October is when I started talking about a climax in markets. I missed it by a couple, just I don't know, about 8-10 days, but I said a climax is coming soon. Now we've broken these lows. It looks like it's going to go lower. There's not really much to stop it. Let's bring up the moving averages here for the 10-year. What do we want? 200, and let's do 50. So we're breaking down below the 50. The 200-day moving average for the yields is all the way down here at 4%. That's possible. It seems like it would be a crazy move, but that is totally possible. Anyway, so that looks like it's coming down. Everybody that was, fear mongering about rates going to 6, 7, 8% higher for longer, all this stuff, it was all for nothing. This is following the typical pattern. I talked about this in phase 1 and phase 2. That's what I called it. So phase 1 is when the 10-year catches up to the 2-year. And phase 2 is when the 2-year falls below the 10-year. So that's what we're seeing here. It's the same playbook over and over and over. The only way this playbook is going to change is if we change the foundation of the global financial system. If we change the money. Until we change the money, they're going to kick the can. It's going to be the same story over and over again. We are not returning to a secular bull market in commodities. We're not going to a secular bear market in treasuries. It was like the worst year in the last 200 years or something last year for bonds. That's going to reverse this year. 2023 is going to be not nearly as bad. I thought it was going to actually be positive. I don't know if we can catch all the way up and become positive for bonds this year because there's not very much time left. Stocks are up. I said stocks were going to be higher this year. A lot of people were talking about recession and crashing stock market and all this stuff. This is the typical pattern over and over again. All right, let's go to oil. And this is the big one. And this is one I've been talking about quite a bit. You can see we dropped through the 200-day moving average here. Below all moving averages, it's just a very, very nasty chart. Nasty, nasty chart. This does not look like peak oil to me, or peak cheap oil. Oil is a lot cheaper today than it was back here on September 27th and 28th. This is ugly. And remember, I think I have it on here. Let's zoom out. And let me go through and try to find all of these. Okay, there's that one. All right, I think I still got them all on here. Maybe I don't have the most recent one. Uh-oh. Okay, but where's the arrow for that? Hold on. Hold on. There we go. Okay, good enough. I think I'm missing one in there, the most recent one. But I will snap that and send that over to Telegram real quick. So this is oil, and it's showing all the cuts that OPEC has made. So back in October of 2022, they cut 2 million barrels per day. In April of this year, they cut 1.6 million barrels per day. And in June, they cut another 1 million barrels per day. So that, no, I'm not missing one. That is 4.6 million barrels per day. What if they were producing 4.6 million barrels more right now? What would happen to the price? It would be devastating. But I said back when they were doing these cuts that they were sealing the fate of oil, because as you cut production, artificially cut production, you raise prices, or you keep prices higher than they should be. And the reason why prices want to fall is because they want to heal the market. People need lower oil prices. Demand is going down, so oil will fall, allowing people to save more and get their books in order so that they can come back with higher demand in the future. But if you keep that price from falling, you're not allowing the healing effects of lower oil prices to fix anything. So you're just locking it in the future. This would be a good time to probably go to this post. This was a Bitcoin Magazine Pro post back from September 27th. I think I probably wrote it on the 26th or something. The headline is Paradox in Economic Headwinds, Recession or Inflation. I think actually they made this public already, and I already went through some of this. But I wanted to draw your guys' attention to these two charts once again. So on the morning of writing this, Zero Hedge had an article, and the headline was Oil Can Push Higher as Cushing Stockpiles Collapse. And I said, this beautifully exemplifies the prevailing confusion. Do inventory levels at Cushing, Oklahoma matter at all to the price of oil? And you can see this is the chart they had there. Back in June, July of 2018 was a low in Cushing inventory. And in June of 2022, and then again here in September, October of 2023. So what I did was I went back and I looked at the oil price during those times. And look at the highs corresponded, the lows in Cushing corresponded with the highs in oil price. Here in June, July of 2018 and June roughly of 2022. And then even today, if I put this chart forward, where would we be at? We'd be way down here below 80. It hit it perfect on the head. What was the date of the top? Let me go to the daily, share this tab again. Okay, so the 27th was the highest daily close. Then the next day it went a little bit higher, but then closed lower. So this article that we're reading through a little bit came out at the high. All right, go back here. I say above, I lined up WTI futures for the same period as the Cushing inventory chart and highlighted the prices at the lows in inventory, July, June. Okay. This is our second paradox of the day. Rising oil prices can cause recessions and inflation at the same time in our modern economy. That's what people think. In reality, it is not a causal relationship. Low inventory levels do not equal tight supply. Both inventory levels and price are symptoms of more basic supply and demand in the real economy. Low inventories and high oil prices mean demand has been outstripping supply. Not that it is going to in the future, but that it already has been. Those high oil prices in turn cause demand destruction, forcing demand to fall, allowing prices to fall and inventory to build. This is very clear on the chart and is the dominant dynamic unless it is met with increased levels of private credit creation. And so that's one reason why I've been going through, looking at bank credit, looking at the sluice data with you guys, because if there's going to be a way to keep oil prices going higher and not cause demand destruction, you have to meet that with increased private credit creation. And we just don't see it. We actually see the opposite. We see a decrease. So the demand destruction from this was going to be massive. And that's exactly what we're seeing right now. Okay, so that was all I wanted to read from that. But let me bring up this one. So speaking of lower demand and demand destruction, I just saw this one and posted this to Telegram a few minutes ago. It's from Markets for Mayhem, Mayhem for Markets. And this account says oil-based lubricants are seeing the lowest levels of demand in more than 40 years as manufacturing slows in the United States. Not exactly a sign of soft landing. So let's make this bigger. And U.S. demand for oil-based lubricants has fallen to the lowest in 40 years, plunging below levels seen during the pandemic lockdowns. So look at that. We're below 100,000 barrels per day in oil-based lubricants. Talk about demand destruction. Now, also another chart that we looked at a few weeks ago was the gasoline demand in the United States as well. It was the lowest in 26 years for, seasonally adjusted for September, say, for the month of September. It was the lowest demand in the month of September in 26 years. It could be the September effect. It could be the end of Q3, as I was talking about for a long time, the seasonal choke points or choke points. And that could be affecting this as well. But overall, look at that demand. What's interesting about this chart is the demand has been declining since 2000, since the .com. Because we shipped a lot of stuff overseas, a lot of manufacturing, I'm guessing, heavy industry, and it never came back, but it's continuing to fall. Now, this goes against one thing that I've been saying for a couple of years now, is that people are going to be onshoring, and the U.S. local economy is going to come back, or the manufacturing sector is going to grow in the United States. But that is just a trend reversal. Right now, at an acute phase, an acute crisis, a fledgling new manufacturing industry. You spent money to redo your factories over here, to move a lot of your supply chains, to move your personnel, maybe hire a whole new group of people. And you started doing that in 2021, 2022. You're running to the end of your runway on your investments. And then what happens? Now we have a huge crash in demand right when you are at a very vulnerable period in your debt rollover, in your debt financing, especially when banks are out there tightening lending standards. So this is just a hiccup in a longer process that's going to take 5-10 years to move a lot of manufacturing, at least nearshoring. So Mexico, maybe some other more friendly jurisdictions out of China into more friendly jurisdictions, including back home to the United States. So this is going to be an ongoing process, but you can see that this demand for oil-based lubricants matches with falling oil prices, falling oil demand, falling demand in the entire economy. So I thought that was interesting. Okay, what should we talk about now? Let's go to this tweet, and I did share this as well with Telegram. From Bitcoin Magazine, looks like it came from a terminal, Bloomberg terminal, but the ETF team from Bloomberg said Bitcoin ETF approval opportunity is the headline. Potential Bitcoin ETF approval window opens for BlackRock and peers. A brief window opens on November 9th for the SEC to potentially approve all 12 US spot Bitcoin ETF applicants, including Grayscale's GBTC. It will be open for at least 8 days. Even if approvals don't arrive this month, we still believe there's a 90% chance of approval by January 10th. That is the last deadline. If they roll over, delay. The last deadline will be January 10th, and they think there's a 90% chance of approval by that time. I think this is a very measured approach, or measured analysis that they do here. Very interesting that there's an 8-day opening here. Must be where deadlines overlap or something with even GBTC's filing schedule. I don't know exactly what, but there is this window, they say, that's opening here for 8 days. And maybe that is what the charts are responding to right now. So very, very interesting. All right. Let's go to this one. I'm going to share my screen with Telegram so you can listen to this. There we go. And
system. And what is Bitcoin? Bitcoin is a currency on the internet. It has no value except to the extent someone else will take it from you as value. Just like that paper has no value except the extent someone else will take it. So Bitcoin is the Iraqi dinar of the internet. And I know intelligent people who, while they're intelligent, are not wise, that have put a bunch of money in Bitcoin. But it's a really good way to turn $1 million into nothing, to play in unstable currencies that they're, and here's what you have. Let me tell you what Bitcoin is. It's WWW. It's the wild, wild west. You're back to the Western banking system. Because all of a sudden, one of these computer nerds just flips a switch. The whole freaking thing's gone. It has no value.
Oh, my word. It's hard to watch this, guys. It is really hard to watch this.
Got completely ripped off, and it took them down. And so the little hipster techie guys are sitting in front of the building with a sign that says, "Where's my money?" Well, honey, you never had any. It's not real money because it's not a stable currency that has any kind of a system that backs it, that has any kind of a system that protects. Well, I've made a lot of money in Bitcoin. You can make a lot of money trading dirt to somebody else trading dirt until...
You can't really make a lot of money trading dirt there, Dave.
People catch on that dirt's not a good idea to trade. You can trade gravel out of your driveway as long as you can get away with it. And so just because you made some money doing it doesn't mean that it was a bright idea. And so...
Okay, people that are like this, they totally discount that we said it was going to happen. We said it was going to happen the way it happened. Also, I mean, that isn't even to mention the technical mistakes in what he's saying here. And we went in Telegram, we went through this. What the hell? He is this smart guy, and he doesn't. It's like, his whole shtick, his whole business depends on you not saving in Bitcoin. Because if you decide to save in Bitcoin and you 10x your money, a lot of your debt problems get less. And his whole thing is about living within your means and getting debt free and all of that. I agree with that, of course. But that fundamentally puts blinders on him, so he cannot correctly evaluate Bitcoin. And he obviously doesn't understand any of the technicals at all. Where some computer nerd can shut off the network. I don't even know what he's talking about there. He might be talking about an exchange. He might be talking about Ethereum and some smart contract that does, Like what wallet was that froze the 100,000 Ethereums? Good Lord, not Polkadot. What was it? I can't remember now. Ugh. But it was the number 2 developer in Ethereum for a long time, and he started his wallet, whatever it was called back then. I can't remember. It's changed its name since. But then someone found an exploit in the wallet and ended up freezing all of a bunch of the ether that were in all of these decentralized wallets because everybody lost sync with the network. Consensus failure. I wish I could remember the name of that wallet. But anyway, that's possible because the Ethereum is a piece of crap that has it's a different model than Bitcoin. But that can't happen with Bitcoin. One nerd can't go in and crash the whole system, obviously. You guys know that. If you're listening to this, you know that. But let's see what else he says.
I'll go ahead and, I got all you Iraqi dinar people and all you gold people all pissed off at me. So let's just go ahead and add you Bitcoin people to the mix. You're stupid. You're going to lose your money. Be pissed at me. You shouldn't have put money in something wacko like.
I mean, it's obviously a marketing stunt. He said, the gold people and the Iraqi dinar people. So how about the Bitcoin people? So, I mean, we're all watching this. I haven't listened to Dave Ramsey in 10 years, probably. I haven't cared an ounce of what he said. I really don't care about this other than we're talking about it. So this is like free publicity for his show. And it probably getting more publicity for this than if he would say, oh yeah, it's okay if you want to put 1% of your savings into Bitcoin. I can see that. Like, that's kind of blah. But if he comes out and attacks us, we're going to be playing his stuff just like I did. Okay, let's go to the next one. This is more on a macro geopolitical front, and I did share this, and we talked a little bit about it there in Telegram. From CNN Business, developing countries owe China at least 1.1 trillion, and the debts are due. Let's read through this. Developing countries owe Chinese lenders at least 1.1 trillion, according to a new data analysis published Monday, which says more than half of the thousands of loans China has doled out over 2 decades are due as many borrowers struggle financially. Overdue loan repayments to Chinese lenders are soaring, according to Aid Data, a university research lab at William and Mary in Virginia, which found that nearly 80% of China's lending portfolio in the developing world is currently supporting countries in financial distress. For years, Beijing marshaled its finances toward funding infrastructure across poorer countries, including under an effort that Chinese leader Xi Jinping branded as his flagship Belt and Road Initiative, BRI, which launched a decade ago this fall. That funding flowed liberally into roads, airports, railways, and power plants from Latin America to Southeast Asia and helped power economic growth among borrowing countries. Along the way, it drew many governments closer to Beijing and made China the world's largest creditor, while also sparking accusations of irresponsible lending. Now, 55% of China's official sector loans to developing countries have entered their repayment periods, according to the analysis of more than 2 decades of China's overseas funding across 135 countries released by Aid Data. Those debts are coming due during a new and challenging financial climate of high interest rates, struggling local currencies, and slowing global growth. Quote, a lot of these loans were issued during the Belt and Road period starting in 2013, and they came with 5 or 6 or 7 year grace periods. And then international debt suspension efforts during the pandemic tacked on additional 2 years of grace, where borrowers didn't have to repay. So how much did this affect the Chinese financial problems they're having over there with all their debt problems? So my basic critique of the Belt and Road from its beginning has been that this is uneconomic investment. It's uneconomic investment. You build a port in a place that never has supported a port and most likely is not going to support a port and traffic in the future. It's going to be uneconomic. That reminds me of like El Salvador. Okay, El Salvador built this big new port in the south of the country. They have that Gulf of Fonza, I think it is, or Fonseca, and it shared this Gulf with I think it shares it with Honduras and Nicaragua, and it has the potential to be this great port. Okay, so they poured in this money and they built up this port. I think it opened in 2010, and it sees like 2 ships a year. It's ridiculously uneconomic. It was a dumb investment. It's the same with all this Belt and Road stuff. Another one of my go-tos is the Kenya Railway. In Kenya, they spent all of these probably hundreds of millions of dollars to build a railway from the coast to the capital city of Nairobi, and it's uneconomic. It loses money. And on top of that, even if they shut it down, there's problems. You have to, well, I guess if they shut it down and they just let it go and have zero maintenance, they wouldn't have that cost, but they still need to repay the loan. So they're having to run this train at a loss. They incurred a bunch of liabilities for different types of jobs, different types of maintenance, different types of upkeep. Now the trains have different upkeep that costs a lot of money. The train tracks, the certifications for all of the people that work now this new fledgling train industry. It's a huge set of liabilities that's extremely expensive. Just because you build some piece of infrastructure does not mean that it automatically is going to produce dividends for these people. It's actually harming them. It is literally putting a noose around the neck of Kenya. All of this bad debt. All this debt to Ecuador, to all around. Some places, yes, that investment is going to go and become profitable in certain places, but it's going to be a below average, whatever the interest rate, 7%, that implies a certain amount of risk for these loans. That interest rate is way too low. Those interest rates to those developing countries where they built all this stuff should have been about 100%, maybe. Something huge. I guess not 100%, but it should have been 50% to properly show the risk of all this. And all of these people are going to default. It's going to be a blemish on the credit history of the country. It's going to lock them into all of these liabilities. It's going to put them at a back foot to China as well. And we talked about, I think this was Friday when we watched a little bit of China Unscripted. And there's a former ambassador to China, and he's talking about how when he went there from the United States, representing the United States, the largest economy in the world, China's biggest importer, trade partner, and his counterpart talked down to him, made him call him by some title and not by first name or anything. And this was a level guy. So imagine now how the Kenyan diplomats, when they go to China and they try to say, hey, we need some more grace period or something, how are they being treated? Very, very poorly. I guarantee you that. Disrespectfully and all that. Buddy.
Okay, I'll take that as a yes.
Sorry about that. Okay, so that is the story here that the developing countries owe China at least 1.1 trillion. And I looked up how much the IMF, because Michael in the Telegram, he had some good points. He pushed back on me on multiple things. And guys, I can be wrong, but I don't think so. And he said that the IMF has just as many. So I looked up, or just as much bad debt out there. And so I looked up the outstanding credit for the IMF, and it comes out to be, this even went down since I looked at it the other day. It was 114 billion. Now it's down to 111 billion outstanding. So that is exactly one order of magnitude less than the bad debt in China, or owed to China. And this is all debt, which probably a lot of it's going to be bad, but not all of it. So I thought that was interesting. Okay, let's go to one more story here before we sign off for the day. And this is RFK. And let me make sure I'm still sharing their Telegram. Okay, so he was talking about Israel-Palestine stuff, okay? And he's big in the Bitcoin space because he came out at the conference, the 2023 conference in Miami, spoke on stage, was really supportive of Bitcoin. He kind of went down a shitcoin route a little bit. He didn't really, I think, if I remember correctly, he didn't really separate Bitcoin from quote unquote crypto. He has had some other concerning positions, at least to me, specifically around climate and stuff like that. But this one might sink his campaign. So we'll see. Because remember, he is a Democrat. He wasn't able to get on, they didn't want to have a primary. So he's like, I can't do anything here in the Democrat Party. So now he's running as an independent. But he is backing Israel 100%. And that is like cuts the Democrat Party in half, because they have half that are these pro-Hamas protesters. And then you have the professional class that is part of the Democrat Party, and they want to support Israel. So let's listen to this. I actually didn't listen to it. I just read this tweet, but
and Israel is critical. And the reason it's critical is because it's a bulwark for us in the Mideast. It's almost like having an aircraft carrier in the Mideast. It's our oldest ally. It's been our ally for 75 years. It has been an incredible ally for us in terms of the technology, the exchange. And, and building the Iron Dome, which we've paid a lot for, has also taught us enormously about how to defend ourselves at home from missiles. So those military expenditures are all going, 75% of it goes to U.S. companies under the agreement, under the MOU. But if you look at what's happening in the Mideast now, Iran is now the closest allies to Iran are Russia and China. Iran also controls all of Venezuela's oil. Hezbollah is in Venezuela. They have propped up the Maduro regime, and so they control that oil supply. BRICS, Saudi Arabia is now joining BRICS. So those countries will control 90% of the oil in the world. If Israel disappears, the vacuum in the Mideast, which is, Israel is our ambassador, it's our presence, our beachhead in the Mideast, and it gives us ears and eyes in the Mideast. It gives us intelligence. It gives us the capacity to influence affairs in the Mideast. If Israel disappeared, Russia and China would be controlling the Mideast, and they control 90% of the world's oil supply, and that would be cataclysmic for U.S. national security. So that's the answer to you.
Well, let me take an economics perspective from this. So 90% of the global oil. I haven't run the numbers, but he's talking about OPEC plus. And all of those countries that are there in the Middle East, I don't think that would, I guess since Venezuela is part of OPEC, that would, and Nigeria and places. So that would probably be 90%. But so what? So what? So they control 90% of the oil, but they don't have anybody to sell to. You know, what if price goes down like it's doing right now? Price goes down to $10 a barrel. It's uneconomic to pump it out except for in Saudi Arabia, basically. And I think Venezuela would be profitable at $10 a barrel if we got better technology and fixed up their industry down there in Venezuela. Maybe some places in the United States, but that's doubtful. The U.S. shale gets profitable around $40 a barrel. So that is, you know, just because they have 90% of the oil production does not mean that they can control necessarily anything. It's very easy to disrupt oil production. Just look at the Strait of Hormuz, pipeline blowups. There's all sorts of other things. So I don't think that it is straightforward that because OPEC would control 90% of the world's oil, that is all that bad for U.S. interests. It would give the U.S. much more optionality. It's just, you know, once we got into the Middle East, once we, you know, into Iraq and into Afghanistan and Syria and stuff, we were locked in there. It reduced our optionality of what we could do. Okay, so that's from an economics perspective. And then from an Israel perspective, I don't want to, I mean, I think both sides are wrong here. I think it's very fishy that there was 6 hours of no border protection in the initial attack. Very, very fishy, as if it were some sort of pre-planned thing on both sides. And the eventual outcome, like if you look 100 years down the road, there probably won't be an Israel there. Especially if we get the America First people in power in the United States, they're going to cut off Israel. And without American support, there is no Israel there anymore. So the eventual outcome is that there's going to be no Israel. Why fight it? It's going to cost a lot of money to fight it. And it's just going to increase the political divide in the United States and push us towards that inevitable future faster. So anyway, that's all I have to say about that. And about RFK Jr., he's sunk. The most he can hope to do is take some votes away from Biden. And I think in the end, he's not going to want to do that. So I have a feeling he's going to drop out. He's not going to make it all the way till next November, a year from now, to the election, because he's going to say, oh man, I'm taking 8 points away from Biden and only 2 points away from Trump. And so I can't actually do this. Even though he doesn't like both sides. Like, he doesn't like Biden and he doesn't like Trump. So very interesting what's going on there. All right, that's going to do it, guys. Let me get back to the homepage here. I didn't even go to the homepage today. But bitcoinandmarkets.com. Check it out. Go there, sign up, become a member, get free weekly newsletter, get access to all of my posts and my podcasts when they drop. And if you want to support the show over there, that's where you can do it. Become a member. You get early access to my blog posts, as well as you get to enter the monthly price forecast competition and a chance to win 20 sats every month, or $20 in sats, not 20 sats. It's something like 37,000 sats or something like that. Yeah. So check that out, bitcoinandmarkets.com. And I'll see you guys on the next one. Bye.